The Open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg The Open with Jonathan Farrow.
Live from New York City, we begin with the big issue, a humanitarian crisis. Russia and Ukraine saying they will make a fourth attempt at establishing a corridor for civilians fleeing areas of heavy fighting. Negotiations coming amid escalating hostilities. The U.S. ready to step up sanctions once again.
There is, I think, a significant not only opportunity but imperative in this moment to finally move off of, for many countries in Europe, a dependence on Russian energy because Russia uses it as a weapon.
The Europeans say no. Bloomberg reporting the U.S. will go it alone, writing, quote, the Biden administration is poised to impose a ban on U.S. imports of Russian energy as soon as today without the participation of European allies. Team coverage starts right now. Down in D.C. with Bloomberg's Anne-Marie and from Brussels, Maria Tadeo. Anne-Marie, you broke the story. The president will speak at 10:45 Eastern. What are we looking for?
Yeah, President setting to speak at 10:45 basically confirms, Jonathan, what us at Bloomberg first reported is that the U.S. plans to ban imports of Russian oil, LNG, liquefied natural gas, and coal. Now, LNG and coal are not big players at all in the United States. I don't remember any imports in modern times, but oil is a big player. 3% when you look at just hardcore crude, 8% when it comes to petroleum products. So still waiting on details on how exactly this is going to work. But Jonathan, really, this was just a matter of time for the administration to solidify what had already been happening in days in the market. There's been self-sanctioning with individual players in the market that just does not want to touch Russian assets, legal issues, or moral obligations. We should note, Jonathan, while Europe is not taking that leap today, there have been consultations with Europe, and they are doing it, I would say, almost with the blessing of their European allies. I spoke to a senior EU official today, and they just said Europe's not there yet. They are just too reliant, and this is how they heat their homes.
Maria, weigh in on that. Where are the Europeans on this conversation?
Look, I think, first of all, it's very hard to say the Europeans because, as you know, Jonathan, from your time in London, this is a market that's very fragmented. Every country has their own energy policy. Some are very ahead in renewables. Others are still very much dependent on gas and oil. And then you have the French that are tripling down on nuclear. But I did have a reaction from a European official in Brussels who tells me, well, in reality, what the United States is doing is not going to change much in real terms, but it does put Germany in a very uncomfortable position. Remember yesterday, the German Chancellor Olaf Scholz put down in writing, so there's no loss in translation here, that Germany simply cannot switch off from one day to another. And I should note, this official also telling me this is coming before European leaders hold a two-day summit that will start in Paris on Thursday. So the timing is key here too.
So AMH, this raises a big question for the administration. Where do they look to for crude products? Saudi Arabia, Venezuela, Iran? What do they do now?
Well, there's a few options, and you named a few of them. One was over the weekend. They went to Venezuela. A number of U.S. officials, potentially they lift those Venezuelan cargoes that are under embargo. We should note Venezuela has the most proven reserves in the world. There's talks of potentially an Iranian nuclear deal. There's been a lot of optimism coming from Tehran on that front. Jonathan, there's also potential of calling the Saudis, putting a little bit more pressure on Saudi Arabia. I would imagine for the kingdom to want to help really put their thumb on this market and make moves in terms of more supply, they would want to know an Iranian deal is closer or not. Is this really going to happen or not before they start to really impact the market? So there's a few players who could potentially immediately have an impact. There's also the United States shale industry. Yep. There are 9,000 leases, permits that are unused. Now, all of them aren't proven to have oil in them, but there are actual leases that could start drilling, but that would not be an immediate effect. And we should note that I'm told the administration has been talking with producers in the shale patch. So there has been conversations.
Those conversations have finally started, have they? Brent crude at 129, WTI at 124. Maria, before you run, I know you've got to catch another flight. Let's just finish on this. There was a story from us here at Bloomberg today on the Europeans making a push for another joint debt effort to fund defence, to fund energy. Is that to fund the energy transition or the higher prices that we're staring at on the screen?
That's a very good question, because, Jonathan, in fact, I'm on my way to Paris because Emmanuel Macron is going to speak with Blinken, and then all of the European leaders will be there on Thursday. And I did get reaction, again, on that scoop that Anne-Marie broke on live TV on Bloomberg. And this official from Brussels tells me it doesn't have an impact in real terms in the operations that the U.S. has with Russia, but it will have a big impact on the price that we pay. And this is a real conversation happening in Europe. We've seen it from pretty much every major country prepping voters and society. This is going to hurt. This is a war that's going to go on for long. And this is now a big question mark in terms of we want to cut reduction from Russian dependency, but we're still continuing to pay. And the money that we pay today goes straight into Putin's hands. So I expect this will be a very tense European summit on Thursday going into Friday too, by the way.
Maria Tadeo, thank you. Over in Brussels, AMH and DC, to you both, thank you. There was a poll outlet yesterday from Quinnipiac, which read as follows. I'll bring you the quote. Might surprise some of you. At nearly the end of week 2 of Russia's invasion of Ukraine, as the US and its allies consider ratcheting up sanctions against Russia, we're set to see that today. Americans say 71 to 22% that they would support a ban on Russian oil, even if it meant higher gas prices. 71 to 22. One poll I know, but does that capture the mood of this country? The mood of this country, seemingly, going by that poll, one poll, backs up the move of this administration we could see later today. Big oil was already there in many ways. We heard from Shell this morning, a bizarre statement from them, announcing their intent to withdraw from Russian oil and gas. The bizarre part of it is they apologized for the move they made last week. They bought Russian crude at a steep discount. We're told there's an energy carve-out. They used it and then still had to apologize. And Ben Van Beurden, the CEO, said this: "We are acutely aware that our decision last week to purchase a cargo of Russian crude to be refined into products like petrol and diesel was not the right one, and we are sorry." Now, just think about that. There is an energy carve-out. They bought the crude, and now they're apologizing. This is the self-sanctioning we've been talking about for the last 2 weeks. The administration may be putting their stamp on it a little bit later, but for the likes of Shell, for the likes of others too, they are not touching Russian crude from here. Let's have the conversation with the team. Manulife's Francis Donald, Bank of America's Savita Subramaniam, and Julie Beale of Kane Anderson Rudnick. We've been talking about this, Francis, already. Are we on a one-way ticket towards demand destruction with crude this morning, Brent at 129, WTI at 124?
Well, there's no question that there will be less demand. It may not necessarily be for energy. However, that takes a longer lag. In the meantime, we know that there's not a lot of what economists call elasticity when it comes to energy. You still got to drive to work, for example. Same issue with food. So we should expect other areas of the economy in the next few months to weaken. That's going to be a problem for central bankers who are going to be looking at a situation knowing they can hike rates as much as they want. It'll have limited impact on oil prices. It'll dampen the part of the economy that's already likely to weaken. So yes, every economist is going to be revising down growth and up inflation. Just mechanically, that's what's going to happen next.
I'm surprised I haven't seen much of that already. Savita, you're perfectly positioned to help me answer this question. If the US consumer is set to pay more for gas, do they spend less elsewhere on discretionary items, or do they beef up the credit card bill? Which one is it?
Well, the answer is it depends on the type of consumer, but what we've seen is that the lower income cohort definitely spends less. And we've seen that it really impacts more of the lower price point retailers rather than, luxury is fairly immune to these types of oil shocks. I think to Francis's point, though, she's absolutely right. I mean, we just cut our GDP and increased our inflation target. So, I think that this is exactly what we're expecting to see is we're underweight both consumer sectors, consumer discretionary as well as consumer staples, because both of those sectors are generally hurt by oil shocks. And I think what's interesting is that we didn't just have an oil shock, last week. We had one last year where gas prices and oil prices effectively doubled already. So consumers that are running out of stimulus, that are starting to feel the pinch of higher gas and oil, the lag even from last year is starting to weigh on them. So I think that that's what we need to keep an eye on is lower price point retailers, discount stores. Those are where you generally see the sales suffer.
Judy, do you agree?
I think it depends on the consumer, but for sure, you're going to expect that the bigger ticket items are probably going to take a hit. You could see some consumers trading down into the discount retailers. You see this with companies like Ollie's and even sometimes Dollar Tree. So I think it's kind of a mixed bag for the retail sector. But overall, I think the consumer is going to be hurt. There just has to be a place where it comes from.
Brutal. Crude higher by, where are we now? Up 5%, up 4.5% on Brent to 128, on WTI up 4% to 124. Francis, Savita and Judy sticking with us. Let's get you some movers ahead of the opening bell. Tons to look at, 20 minutes out. Here's Abby.
There is certainly a lot to look at this morning, and with the futures basically mixed and unchanged, let's take a look at some of the commodity movers sticking with that theme, because of course the energy complex is mainly doing well with oil at its 2008 highs. We have ExxonMobil heading to an 8th straight up day, the longest winning streak in more than a year, and this of course ahead of President Biden's expected announcement on a U.S. ban of Russian oil imports. But the strength extends, I should say, to gold, because of course with all the chaos in commodities, with that crazy nickel trading, we have some of the gold miners higher, and at this point you have Anglo Gold already up 30% year to date. It's set to add another 2.5% to those gains on the morning, John.
Abby, thank you. Coming up, the United States pushing back on Russia's invasion of Ukraine.
Peaceful coexistence has two words. The first is peaceful, and Russia is doing everything in its power.
Progress starts the moment we see global challenge for what it truly can be. Motivation. Advance your future with Deloitte.
The Omicron variant and the latest wave have an impact on not only consumer trends, but your business. And do you expect the booster shots to make a difference?
Yeah, booster shot will make a huge difference. I think it's been accelerated by the huge leadership of the current Prime Minister Kishida. And I'm hopeful that our business will come back in Japan around perhaps mid-February to end of February, because we expect that a peak time will come around that time. And then the government will shift toward the reinvigoration of consumer. That will help us. And we had seen the huge comeback of the business in December when the things were toward the normalization. So I believe the business will come back, and I'm very much hopeful.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Invades Ukraine.
We have proven our strength.
The nature of this war changed yesterday.
Turn to Bloomberg for up-to-the-minute reporting from around the world.
Ground troops are closing in on the Ukrainian capital.
Swiss abandon neutrality.
And analysis of what it all means to you.
Energy is on the table.
We could see oil prices moving closer to 120.
There is a lot of interest to offload Russian assets.
Look to see more companies announce their exits from Russia.
Keep it tuned to Bloomberg Television and Radio.
If Russia wants to engage in peaceful coexistence, which of course, in principle, we welcome, it needs to start by actually making good on the word peaceful and ending the war, the aggression that it is committing in Ukraine.
Russia's invasion of Ukraine sharpening fears of commodity shortages. The LME halting trading in nickel. This coming after the metal rose by as much as 250% over just 2 days, through 100,000 at one point. Javier Blas of Bloomberg Opinion joins us now for more. Javier, I'll repeat what I said to you earlier. You said this a few times. Something's going to break. And Javier, it broke.
Well, the London Metal Exchange nickel market certainly broke. Trading is suspended. I don't think that we are going to have trading tomorrow and perhaps for the next couple of days. There is a huge mess in the nickel market at the moment, and market participants, the banks, the brokers, the traders are going to need a bit of time to sort out every position. We are going to need also a plan what to do with the short position that triggered all the chaos, a Chinese company, how that's going to be settled. Probably is going to have to be private conversations outside the exchange. And then we're going to need a bit of a plan on kind of the medium term of how to avoid the repetition of this. And we're going to need the British regulator, the FCA, deeply involved, that so far that they appear to have not really been that involved into the situation, so the market can regain confidence. But that is not something that it can be resolved in the next 8 hours. So I'm expecting that trading will not restart tomorrow.
You think it will be shut again tomorrow, Javier?
Yeah, I think that we're going to be shut down tomorrow and potentially Wednesday. I'm talking to a number of traders, brokers on the market, that they think that they need a bit of time to really go through every position and try to start sorting out everything. I think that if the exchange tries to restart trading tomorrow, we're going to be in the same situation in a few hours' time.
Javier, was this just one man with a range of brokers, or is this a broader story where we're going to see a lot of people get hit and hit hard?
I think that we're going to, at the moment, we are seeing one man and one big Chinese company, but certainly some of the banks supporting the position and some of the brokers are going to be hard. The losses that we are hearing are calculated into a handful of $1 billion. So this is not going to be cheap. It's going to be a big hit for the London metal market.
It's going to be expensive, that's for sure. Javier Blas, thank you, sir. As always, buddy, we appreciate it. The energy story stateside, energy on the S&P 500. We are higher by 37%, the highest in more than 7 years. I want to turn back to the desk. Francis Donald, Julie Beale, Savita Subramaniam. Savita, I want to come to you on just some of the energy names, if I can, and start here. We've had a move of 30, 40%, up 37% year to date. Do you start to get to a point where you look ahead further down the line into next year and say, this outlook for this cycle doesn't look good right now. I'm not sure I want to own those names anymore.
You know, we've had a big move in energy, but you need to think about the big downward move that we had before last year. And I think that that's what's important to keep in mind, is that if you look at valuations, they're still relatively attractive. These companies are generating free cash. They've got capital discipline. I think it's a different type of sector. What I would watch in order to know when to get out of the sector is valuation and positioning. And both are still generally constructive. In fact, it's interesting. Fund managers have not necessarily bought into the energy sector. They're still quite underweight. And I think they've been buying, other areas like industrials. And we talked about this on your show. Folks just don't want to own energy stocks because of all the ESG kind of stigma around fossil fuels. So there is this issue right now where energy is a big enough sector where if you're not in it and it's doing well, it will actually hurt performance. And I think that's one of the reasons that we could continue to see some buying or some capitulation into the energy sector, going forward. Positioning is still very light. Free cash flow is still very healthy. And then again, our big theme is inflation protected yield. And when you look at energy companies, their free cash flow yield is, 9% relative to tips that are yielding real where the yield is negative on a real basis. So I think it still has a lot of attractive opportunities despite its strong performance.
Julie, I'll come to you on the same question. Are they names you still want to hold on to?
I think for us, it's very uncomfortable owning stocks that with, Putin's changing his mind can undo a lot of the gains. So for us, that's a sector that's not super appealing. It's hard to have differentiation. That said, I would like to put in a plug for Putin, great job uniting the whole country, the whole world, as it turns out. I really appreciate that on his part. But energy sector, for generally speaking, not for us. But I think there are sectors that serve energy that have better business models. They're more differentiated because what we're trying to do is own businesses over the next 5, 6, 7 years.
Francis, that's the difficulty, and I think Julie touched on it. The headline risk, de-escalation risk. That's one risk that we don't talk about enough. We know the escalation risk. We know what that might look like. Are we at the point now where de-escalation risk, Francis, might be the bigger risk for a market that's seen a huge dislocation in the last couple of weeks?
Well, this market is so focused on the Russia-Ukraine conflict, which it should be because it's a sizable shock. But Savina's made a comment a couple times I think is critical. Think about contextualizing this. Where were we a month ago? We were in a flattening yield curve. There were signs that the cycle was extended. Consumer confidence was declining. Real wages were declining. I think if we focus too much on just Russia-Ukraine, clearly a huge risk. We're going to miss that this market was already flashing yellow on red on a lot of the major economic signals. So even if we see de-escalation of Russia-Ukraine, which as an economist, I can't model, I'm still going to be looking at weak growth for Q1 and Q2. That Atlanta Fed now GDP was tracking around 0% growth for Q1 before Russia-Ukraine came in. So yes, de-escalation, yes, we should be looking at upside risks as well, but let's not forget the long list of downside risks that we were dealing with before we got this headline shock.
And then the rate hikes in the mix. Where I think you might disagree with the team at Bank of America is this one. Savita, are you still at 7 hikes for this year? Is Ethan Harris still looking for 7, one at every meeting for 22?
We're still looking for 7 rate hikes, and I think obviously data dependent, and the Fed has been very vocal about watching trends to sort of pivot on a real time basis. I think though again, I think what's important to remember is that 7 rate hikes doesn't even get us to a neutral rate. I mean, we're still at a super low, relatively accommodative level for short rates. So I think that's important. Is the delta might sound really extreme. 7 hikes sounds like a lot, but think about where we are right now. We're at 0 on short rates. We're below 2% on the long end. Meanwhile, we've got inflation running rampant. We've got crude oil at, above 100. I mean, it's kind of a disconnect right now. And I think that what they need to do and what they've said they're going to do is essentially resolve a bit of that by, increasing rates a bit to 175, not the end of the world, and and staying the course this year. So we are sticking with that 7 rate hikes.
Francis, can we get to 175 without breaking something?
I don't think we can get there this year. Remember, typically when the Fed hikes, they're doing it into rising PMI, strong growth, an economy that's reaccelerating. In this case, they're actually going to be tightening into a decelerating economy. So I also have 7 hikes, but I have them over the course of 2 years because in that sense, they'll have to proceed more slowly in my view. But let's not forget QT, because I do expect there to be sizable QT along with these 3 rate hikes in year 1. That is another form of tightening. So I don't think that 3 versus 7 actually sounds as extreme as it might over the headline. We're still looking at a central bank, indeed central banks globally, that need to normalize even amongst this volatility. The question is, how fast can they go? I think they're going to run into troubles around the middle of this year.
Awesome lineup this morning. Francis Donald, Julie Beale, Savita Subramaniam sticking with us through the opening bell. Coming up, the morning calls. And later, crude rallying to 129 on Brent, 124 on WTI as the Biden administration prepares to impose a ban on U.S. imports of Russian energy. That's all coming up from New York. This is Bloomberg.
Soaring energy prices and a short supply of key chemicals that produce synthetic fertilisers are sending pig, cow and horse manure prices soaring. Even human waste is in demand as farmers hunt for alternatives. Fertiliser helps increase crop yields.
You can see how much moisture is held into this. It's a lot of organic material into the compost, so it breaks down. The manure and the straw breaks down into a friable mix that can be mixed into your soil in the ground and for growing a whole range of different vegetables. Holds the nutrients in, holds the water in, and it really increases the kind of biodynamic profile of the soil.
The recent price spike could mean more farmers going organic for the long term.
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
Happening this morning, we expect to hear from the President of the United States. Bloomberg reporting that we could have a ban on Russian energy into the United States. Futures up 0.2%. Here's the move on Brent, approaching 130. Right now on Brent, 128.66. That's the price action. Here are your morning calls. First up, Bank of America downgrading ConocoPhillips to neutral, seeing limited upside amid surging volatility in commodity prices. Baird upgrading Bank of America to neutral. The analyst now seeing a more favourable risk reward following recent declines. And finally, Consumer Edge downgrading Conagra to equal weight, expecting food costs to remain elevated throughout the war in Ukraine. That's a real tragedy worldwide. Coming up, Brent jumping to 130, with the Biden administration preparing to impose a ban on US imports of Russian energy. That conversation is just around the corner, with equity futures this morning positive by a little more than 0.1%. And in the bond market going into CPI on Thursday, yields higher by 8 basis points, 10s at 185, 2s at 159. This is Bloomberg.
At the Delhi airport, and behind me you can see SpiceJet 737 MAX aircraft. SpiceJet Chairman Ajay Singh earlier today said that Boeing is going to compensate SpiceJet in form of cash and aircraft. Celebration happening at the Gwalior airport. As you can see, they've literally rolled down the red carpet for SpiceJet Chairman Ajay Singh. There are balloons, there are flowers. This is a big deal for SpiceJet because it is the only Indian operator of Boeing 737 MAX planes currently.
A lot's happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
We need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
"23 seconds away from the opening bell. Good morning to you all. This morning, we're positive by just about 0.1% on the S&P, on the Russell up by 0.2, on the Nasdaq down by 0.3% or so. The story's not here. It's in the commodity market. The opening bell in New York City rings. Switch out the board and get to the commodity market. Crude looks like this. WTI 125 up by 5%. The president speaking, set to speak, scheduled to speak at 10:45 Eastern. I laugh because you never know. That's meant to be 1 hour and 15 minutes away. Typically, he turns up a little bit late. We've got a preview from the team down in D.C. The president expected to announce a ban on Russian crude imports. Look out for that. Euro positive, euro dollar 109. They could make that move without European allies. The euro stronger off the back of a report from us here at Bloomberg that we could have a joint debt effort again to fund defence and energy on the continent. I'm sure Guy Johnson's going to be talking about that in about 30 minutes. Yields are higher by 8 basis points to 185.77 on 10s going into CPI this Thursday. That's the cross-asset price action with your movers at the open. Here's Abby.
John, well, sticking with the oil story, the natural resources boom, this commodity move that we're seeing, just really incredible right across the board. Oil in particular, very strong. The energy complex is up and away, especially some of the refiners, including Valero and Holly Frontier. But it's interesting, John, we also have a bid for alternative energy. The likes of Sunoco and Plug Power also higher on this morning. Interesting, taking it to another leg, you would think that this would impact travel in a negative way. The rising cost of jet fuel, we've certainly seen that. But today we actually have strength for travel. So we have this strange tension between this energy crisis and the desire to reopen today. The desire to reopen relative to travel is working. But energy, as you know, the top sector in the morning.
Big time, up 2% around the opening bell, about 35 seconds in. Your equity market is flat. Move to the downside on consumer discretionary. You might expect that. We're down by 0.6% for that industry group. Looking at crude close to 130. Let's get more with Kaylee Lyons. Hey, Kaylee.
Hey, John. Well, with commodity prices this elevated, it feeds into fears of inflation, which actually is now morphing into fears of stagflation. And you see that reflected a bunch across a bunch of, if I can get my words out, different assets. One of them being, of course, the yield curve is what we look at, which has been consistently flattening over the last year. That gap between 2- and 10-year yields now sitting around 26 basis points, which actually is even a little steeper than where we were yesterday, but still is about the flattest going all the way back to March of 2020, which, of course, is the height of the pandemic recession. And that basically indicates that concern that the idea that policy is going to get too tight and choke off growth down the line. And, of course, you have the yield curve, you have higher commodity prices, you have stocks that have been selling off, all of that fueling the fire around concerns about recession. And just to linger on stocks for a moment, I wanted to point to this from Citi. Global earnings revisions are actually in negative territory for the first time since September of 2020. So more net downgrades than net upgrades to forecast. The strategist there saying that is a game changer as it removes fundamental support just when liquidity is also about to be sucked out by central banks. So in that kind of environment, where do you put your money, John? Usually in periods of stagnation, it's defensive stocks that tend to outperform. And that is definitely what we have seen over the last 2 weeks. When you remove energy, because that is far and away the outperformer for obvious reasons, thanks to the oil price, the other top performing sectors in the S&P 500, utilities, real estate, healthcare, all of which are defensive sectors, John.
Kelly Lyons, thank you. The team over at Citi using that word, stagflation. The S word reads as follows. Concerns are rising as the fallout from the conflict in Ukraine threatens to weaken economic growth while lifting inflation. The recent sharp drop in real yields means growth strategies should do better. We have a preference for growth over value with some mild cyclical tilt with value. Let's pick up on that word stagflation and get to the team. Francis Donald, Julie Bill, Savita Subramaniam. Julie, do you subscribe to that? Is that a framework to explore stagflation?
Absolutely. I think the problem that we have right now is higher oil prices mean that there is likely going to be more aggressive Fed action. But I think the true question is, does this lead to demand destruction? And we can go back historically and see all of the periods where oil prices rose dramatically, and you see meaningful demand destruction. And since the U.S. economy is generally a consumer economy, it has meaningful ripple effects throughout. For us, we would pay attention to smaller mid-cap software names that have high levels of recurring revenue, durable earnings growth. I think those are the places to hide out, and I would call them your comfort stocks.
Can you talk to me about banks as well? Julie, we're talking about higher rates, and yet banks have backed away. We're talking about higher energy prices, yet at the same time, we're also considering what may or may not happen with energy equities as we start to explore demand destruction a little bit more. Julie, what do you think all this means for the banks at the moment, which are very much on the back foot year to date?
I think it's been interesting. We had all assumed that the higher interest rates would translate into higher prices for the banks. And I think if you look at the mega caps, that hasn't really panned out, partly because I don't think their exposure to that is so strong. Your smaller banks, they have more of an impact from a rising rate environment, but they have converse effects as well in terms of, is there going to be more lending if interest rates rocket higher? So much of the smaller banks have been benefiting from a really strong housing market, and that may disappear over time.
Down 12% year to date coming into today's session. I think the lowest in more than 12 months. Savita, where do you stand on the financials, on the banks more specifically?
Look, we're overweight financials. And I think that the sector has, as Julie rightly pointed out, this sector, especially the large cap banks, are not necessarily as impacted by the yield curve, by rates. I think this is a source where you still have relative value. You have a sector that has basically de-risked after the crisis. The leverage ratios are at close to all-time lows. Even during the global pandemic, you saw earnings of the banks remain relatively, stable versus other cyclical sectors. So I think that this is kind of fits in with our quality income theme. I personally think we're going back to a time where we're going to buy bank stocks for the quality and the dividend yield rather than this levered bet on housing, which was the story in 2008. I think the sector has transformed itself. I think the other kind of theme for banks and energy is that they are still, despite their strong performance over the last 12 to 18 months, these are still very underweighted sectors by the buy side. So I think that there is less crowding risk within banks and energy than there is within some of the growthier areas of the market like tech, TMT, et cetera. So I would stick with financials. I don't think that they're necessarily hurt by a flattening yield curve. We've done the math, we've done the work, and we haven't necessarily seen this strong relationship between yield curve and financials companies. So I think it's a sector that's unloved, still relatively inexpensive, and much higher quality than it has been, in prior.
Savita, when you say you've done the work, do you mean you've done the work on what the yield curve means to profits, or you've done the work on what the yield curve means to investor attitudes towards the group of equities? Because what I often find is that the bank analysts on the single names will tell you what actually matters to the banks and profitability is not where the 10-year yield is at. But for a lot of people in the broader market, it shapes their attitude towards allocating money to the financials. So does it matter? Doesn't it matter? And what does it actually matter to?
That's a great point. And I think therein lies the opportunity. If the macro folks and the generalists are getting it wrong and the banks are actually moving and generating profits on different factors, I think all the more reason to really step in. And, I think that one of the issues that's been created by this sort of macro focus is we can trade ETFs and sectors really easily now. So, the financial sector has moved in lockstep with the yield curve, whether it should or shouldn't, because of this investor sentiment. Again, I think this is a great time to pick stocks. And I think what we need to do now is the work of listening to the fundamental analysts and figuring out where the macro folks are getting it wrong. I'm a macro person, but I know that a lot of these relationships that we've tested that seem like they would work don't necessarily work.
Francis, your world, are the macro folks getting it wrong?
Some are. I think it's funny that we hear it's concerns about stagflation are starting to rise. It's too late to start getting concerned about stagflation now. We're already in stagflationary dynamics. Q1 GDP tracking at 0%, and CPI is going to hit an 8 handle this week. I mean, now is the moment where growth is going to be too low relative to comfort and inflation too high. But how do you translate that? And that's why we need people like Savita and Julie, because even we have looked at past cycles and said, well, yes, every recession is preceded by a huge jump in energy, but we're in a different environment where energy is less of the consumption basket. 2s, 10s are on the brink of inverted, but is there an adjustment that needs to be made for the term premium, or is the Fed's buying creating distortionary impacts? So I think macro folks generally can get it right, but that doesn't mean they know to necessarily translate that to the trade. And that's why, even as a macro person, it pains me, we always need good people to pick good stocks.
Francis, can you talk to me about the yield curve? Seemingly the only two people that talk to me about the yield curve at the moment is my friend in the bow tie and my friend Bramo waiting for the apocalypse. Now, I want to understand, Francis, why no one brings that up anymore. You've identified the same thing. Typically, when you get to about the 20s, it's all I'd see everywhere. Now people don't talk about it as much. Do you experience the same thing?
Well, absolutely. In 2019, 2018, it was all anyone would talk to me about. There might be a few reasonable reasons for this. One is that we're not seeing the same level of inversion across the entire curve. So, for example, the longer end is not inverting so much with the 3-month. So that gives us a little bit of a pause. Second, we understand there are distortions with the yield curve. But just take a step back and look at this. We've been flattening for over a year. This is a market that is saying the Fed is going to have to respond to stagflationary dynamics, which means they're not going to have any cover to pivot, which means that front end is going to have to rise, and we have not seen ourselves exit into escape velocity for the long end to come out. A lot of that, I think, is also fiscal being reflected. We didn't get game-changing fiscal, and we haven't seen game-changing productivity. So all the macro factors that would drive that long end higher have not materialized. That's very unlike what we thought would happen when COVID first hit, and we thought it'd be a game changer for long run growth.
The 2s, 10s closed out 2021 at 77 basis points. 2s, 10s right now at 27. Judy, Bill, you get the final word on this one. The final word, please.
Well, I think if you look overall at the economy, the risks are definitely towards the downside. And for us, as longer-term investors, we're looking for the quality businesses, ideally businesses that have been through these types of cycles before. And so it's a great time to be a fundamental investor, to actually look at the earnings. So many of these stocks have been beaten down indiscriminately, and I think it's a real opportunity for those who are looking at quality.
Do we really have to wait for International Women's Day to do this panel every day? Can we just do that, Monday to Friday? If you find an hour for me every day around 9 Eastern, we'll continue to do so. Francis, thank you. Savita, to you as well, and Julie. What a lineup. Fantastic. Thank you very much. About 11 minutes into this session, equities pulled back 0.2% on the S&P 500. Crude approaching 130 on Brent. Coming up, Secretary Blinken setting the stage for sanctions on Russian crude.
With regard to a potential oil embargo, an embargo on the importation of Russian oil, this is something, as I mentioned, that we have been discussing within the administration.
That's next. This is Bloomberg.
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
It's almost the end of the year, but Bali is still quiet and empty. I am here in Kuta Legian, one of the main walking streets here that is used to be a tourist spot for beach, dining, shopping. But many shops here are still closed. Most of the outlets are either for rent or for sale as they have run out of business.
Saya kerjanya di sini udah lama, udah ada 10 tahunan di sini kerja. Masih sepi sih, nggak kayak dulu. Kalau dulu kan rame, sekarang ya ada 1-2 itu ada. Tapi nggak kayak dulu, kalau dulu rame sekali. Sekarang paling dapat jualan ya 100, 120 gitu. 200 ya. Kalau dulu sih ya nyampe dah 1 juta, 1,5 itu nyampe dapat jualan. Bisa sampai 2 juta dulu. Sekarang nggak pernah lagi dapat segitu. Sama aja. Belum ada turis ke Bali. Masih ya domestik aja.
While Bali has reopened its borders for foreign tourists since October, they're still not coming in. Many international airlines are yet to reinstate their direct flight to the island. Balinese people here really hope they can see more people from Australia, China, and Europe to come visit next year.
With regard to a potential oil embargo, an embargo on the importation of Russian oil, this is something, as I mentioned, that we have been discussing within the administration. The president discussed this as well yesterday when he had a call with the French president, British prime minister, and the German chancellor, and something we're very much actively looking at.
As we know, the Germans have said no. They said that yesterday. And what we've learned this morning here at Bloomberg is that the president is set to announce a ban on Russian energy. Europe won't be joining them. Julian Lee joins us now for more. Julian, I want to get you on a headline I've just seen from Germany that takes us to the other side of the story. We'll be focused almost exclusively on what a ban of Russian energy into the United States means for the oil market. And we can touch on that in a moment. But Germany just said this. Germany is prepared for Russian energy curbs. Julian, I don't think we've quite spent enough time considering what the reaction to the action we're about to see will actually look like from the Russians.
Yeah, I think this is going to be, a big part of the picture. Everybody's been talking about how Europe and the US should impose sanctions on Russian oil exports, potentially on Russian gas supplies. But relatively little has been said about how President Putin may react to even initial sanctions on oil supplies. And obviously his biggest weapon in that sphere is gas exports to Europe. And I think you have to factor in the possibility that he would retaliate by closing down the pipelines that bring Russian gas into particularly into Germany, but into many other European countries as well.
Julian, this gets messy and potentially messy very quickly. Can you work me through piece by piece just what we know so far, based on our reporting? Based on our reporting, we'll get this decision from the president. He speaks in about an hour from now. A decision to ban the import of Russian energy. Europeans don't go with them. Is that just moving the deck chairs a little bit? Does the US go somewhere else for crude and Europe ultimately stays with Russia, maybe takes a bit more of it, China comes in? Does it really change anything?
I think firstly, I think it sends a very important signal that those who can will clamp down on purchases of Russian oil, gas and coal, which I think is what the Biden administration is talking about, all three sources. Now, obviously it's much easier for the US to do that than it is for European countries. We might see some other countries in Europe taking similar positions. I mean, it's quite possible that the United Kingdom might follow suit. We here are much less dependent on Russian supplies than some of our counterparts on the continent. And there is this possibility of chipping away. But as you suggested earlier, the retaliation to that might be a very rapid escalation from the Russian side. Now, that's not cost-free. Yes, Russia may be able to divert at least some of its oil exports elsewhere, but the only way that it would be able to do that is to put that oil on tankers, either in the Black Sea, if the tankers will go to Russian ports, or in the Baltic, and then ship them a very long way round to China or anyone else who will take them. That's going to add massively to the cost and the time it will take to deliver them. For gas, if he doesn't ship his gas to Europe, he's not going to be shipping it anywhere because the big gas fields that supply European markets aren't linked to pipelines that will take that gas anywhere else. So for him, yes, he can cut off those supplies, and he may calculate that will do more damage to European buyers than it will to Russia, but he can't divert those gas flows anywhere else quickly.
Just got a headline, Julian, that the UK is to announce a ban on Russian oil imports as well. Clearly, for Europe, this is an important issue. For the EU, for the Germans, for the French. For the US, less so. Where does the UK fit in, Julian? Just their dependence on Russian energy.
I think it clearly fits between the two. We take relatively little energy from Russia. There's quite a big presence for Gazprom trading in the UK, but that's typically trading gas that it gets from elsewhere rather than molecules that actually come from Russia. For oil, it's a little different. There was a case of a tanker full of diesel fuel that unions said that they wouldn't unload earlier in the week or at the end of last week. We do take supplies of Russian fuel. We do take supplies of Russian crude oil. We are going to have to replace those from somewhere, and it could get quite tricky. The diesel market in Europe is already pretty tight. And so cutting off a significant source of supply in Russia is going to cause difficulties. But it's something that I think has to be done. The worst situation we could possibly put ourselves in is the one that we seem to be in at the moment, which is continually threatening that we might impose some sort of sanctions, which then forces prices up. But by not actually doing it, we're simply paying more for every barrel, every cubic meter of gas that we buy from Russia, and we're filling the coffers of the Kremlin.
Julian, that's the story of the moment. It's become almost a moral obligation to pull back. It's no longer about what it was just a couple of weeks ago, which was about hurting their economy without hurting our economy, they being Russia and us being the UK or the United States, for instance. Now it's about a moral obligation. That seems to be the perspective shift that we've seen from the US administration and others. Do we have a moral obligation to pull back from Russian energy? Julian, thank you. Just to run through those UK headlines. So this is it. The UK to announce a ban on Russian crude imports. The ban on Russian oil to be phased in over months. Won't happen immediately. The UK decision will not affect Russian gas imports. This according to an official in the UK. So I'll go through that again. The UK to announce a ban on Russian oil imports. It will be phased in over months, but it will not affect Russian gas imports. That's according to an official. That last piece of information, I think, is really, really important. What it will affect, what it won't affect. And if we get a US decision a little bit later today, listen carefully to the language. What is it? Energy, all of energy, including crude products, just crude, liquefied gas and coal. That's what we want to hear from the president for just a little bit later. The president of the United States speaking within the next 60 minutes or so from New York. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Mercedes-Benz is on a path towards CO2 neutral mobility, so we have flicked the switch there and really...
This flashlight can burn through anything. Cardboard, plastic,
"25 minutes into the session, expecting to hear from the president at 10:45 Eastern Time. The US set to impose a ban on Russian energy after the UK makes a move to do something similar. Futures look like this going into the open all over the place, and now, about 25 minutes in, the S&P 500 cash story is down 0.2%. That's the equity market. Here's the trading diary. The president of the United States discussing actions to hold Russia accountable for its invasion of Ukraine at 10:45 Eastern. Secretary Blinken meeting with French President Emmanuel Macron at 12 p.m. The Treasury selling $48 billion in 3-year notes at 1 p.m. US CPI coming up on Thursday, looking for something close to 8% on inflation. Shortly thereafter, seconds later, you will hear from the president of the ECB in a news conference. 45 minutes before that, you'll get an ECB rate decision. Finally, to close out the week, UMich Consumer Sentiment Survey coming up on Friday. The focus this morning, very much on the energy market, with Brent at 131, approaching 132, with the President of the United States speaking a little bit later. From New York, this is Bloomberg.
This chip shortage is going to last longer than many people believe, likely straight through this year. And I wonder what that means for prices. Will this get worse before it gets better?
I don't know that it will get worse before it gets better, but there's no reason to believe it's going to get meaningfully better anytime soon. The Commerce Department put that data out yesterday, and what it showed is that there's a real shortage. Demand is 20% higher than it was a couple of years ago. There's a huge mismatch in supply and demand. Prices are high. Prices are higher. So what has to happen is we need to make more chips. Unfortunately, there's no easy solution. The solution is increased domestic manufacturing of chips, which is what we need to do.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Businessweek about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands. And it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
I won! Look for the winning number in Sari stores every day, also on TV, radio, and newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now. But in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100. So $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number Fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number Fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with Number Fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the street, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their million-peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for Number Fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, "Pepsi goons bomb their own trucks." And when I visited the MBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them, to try and curry favor. I just thought that was so shocking, and of course Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the Number Fever campaign. Del Fierro thought Pepsi's Number Fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees, but for people who couldn't afford the money, he would just represent them pro bono.
Alliance is to build up pressure comes at you. And so you see people marching in the streets. So we had mounted our own campaign, even in the U.S.
He flew to America and he hired two consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard in America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi-Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fierro's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 113, also 3 times a month. Also, there was a time my father was hospital due to heart failure. Still, he had to attend the 2 branch hearing. Otherwise, for not attending, the judge will issue a warrant of arrest to my father. My father passed away January 13, 2010. After staying for almost 1 year in the hospital, he died of complications due to heart failure. After the death of my father, I was inspired to do the website. PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, they claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19 they didn't have access to their documents about this, but you know, they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi number fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's number fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning $1 million pesos, losing it, and then returning to their normal life in poverty in Manila.
When the news of the bombing came out, it was a massive story in Germany.
We are following some breaking news coming to us out of Dortmund in Germany.
It was covered by all the media outlets.
3 roadside explosions triggered at the same time last night as a coach left its hotel in the south of Dortmund.
Public figures commented on it.
We should not let them affect our life, whoever it was.
The media echo went far beyond Dortmund.
I think it was front page news in every single big paper around Europe. Everyone thought of like a terrorist attack, and people were scared that throughout the city in Dortmund there was more attacks to be happening.
Unbeknownst to investigators, just after the bomb went off and the players of the team were shell-shocked. The person who had masterminded the attack was actually sitting in the hotel eating steak and sweet potatoes. My name is Thomas Rogers. I'm the journalist who wrote the article, The Get-Rich-Quick Scheme That Nearly Killed a German Soccer Team. Dortmund is a mid-sized city in the western part of Germany in a state called North Rhine-Westphalia. And it's a former industrial city that's kind of fallen on hard times in the last few decades. It was severely bombed in the war, so the center of the city is quite stark. Some of the few high points include its soccer team.
My name is Ike Henning. I'm a reporter with Bloomberg News, and I'm a great fan of Borussia Dortmund. Dortmund fans are super loyal. On all match days, the entire city is in black and yellow. It's like a religion.
I think more than most German cities, soccer does play a very large role in the identity of Dortmund. In October of 2000, the BVB became the first team in the Bundesliga to actually go public. Salaries for soccer players in the Bundesliga have gone up very dramatically. With such high prices, they thought that by going public, they would be able to compete better with big teams like Bayern Munich.
Unfortunately, that didn't go too well. Dortmund bought too many expensive players, high wages, and the club almost went bust in 2005.
The price of their shares, it has sometimes gone up, but mostly gone down since they made that decision. So on April 11th, 2017, the team was staying in a hotel on the outskirts of Dortmund.
Match days are always special in Dortmund. Everyone is looking forward to it. The team always meets in the same hotel ahead of matches.
They stayed in this hotel in order to have a kind of neutral space before games so that they could concentrate, be sort of isolated from distractions, things like that.
Everyone was pretty optimistic. They had a chance to go really far, maybe into the finals. I was in the office and getting ready for match day. I was going to meet with a friend, a fellow Dortmund supporter, in a pub. As always, the fans are very excited about matches.
On that day, they were heading to play in the quarterfinal against AS Monaco at Signal Iduna Stadium, which is in the center of Dortmund. Shortly before 7 p.m., the players of the team boarded their official team bus.
When the bus took off the parking lot of the hotel and turned on the street, there were three detonations, 3 bombs that exploded and hit the bus of Dortmund.
3 explosions occurred close to the Borussia Dortmund team bus. The B team bus had just left the hotel. The explosions destroyed 2 windows in the rear part of the bus.
People screamed, people jumped to the ground.
The fellow Dortmund fan I was supposed to watch the match with, he called me and said, turn on the TV, there was an attack on the Dortmund bus. And I thought he was like, that was impossible.
Some of the players screamed at the driver to keep driving as fast as possible because they were worried that people might storm the bus.
German investigators say the explosive devices used in the attack on the Borussia Dortmund bus contained metal pins and that one had pierced a seat headrest.
Unbeknownst to the team members, the actual mastermind behind the attack was, as they were disembarking the bus, was actually eating steak and sweet potatoes at the hotel they had just left.
Authorities are attempting to verify a letter left at the scene claiming jihadists were behind the attack.
Because there had been a series of attacks by Islamic terrorists in Germany and Europe, there was widespread suspicion in the media that this was another Islamic terror attack. 3 letters were found at the site of the bombing that took credit for the attack on behalf of Islamic State. There were, however, reasons to doubt this particular narrative.
Would actually be a surprise if ISIS were actually part of this attack. Possibly could be employed by other groups like the far right wing to try and shift the blame.
The letters had some strange qualities. They were written in a strange German that used big sophisticated words, but had basic grammar mistakes, as if someone was native German speaker but pretending to be a foreign person.
Federal investigators have detained one man suspected of links to Islamist terrorism, one of two suspects whose apartments were raided this morning.
Shortly after the bombing, a man in Austria named Rudolf, who was a big BVB fan, he noticed that something strange was going on the stock market related to the team's shares. He emailed the lawyers of BVB, who then forwarded that email on to investigators. The email stated that someone had bought 60,000 BVB put options, a wager that the value of the shares of the team would fall below a certain amount at a certain date.
Why would someone buy that ahead of a match and then 3 bombs go off? Something isn't right here.
For the person to make money off of that, it required the stock to go down quite a bit in a fairly short period of time. And it wouldn't just be the team losing a match, it would require something much bigger than that. There was another big red flag about this purchase, which is the fact that it had actually been made, number one, on the day of the bombing, but also from an IP address that had been traced to the actual hotel where the bombing had taken place.
When 3 explosions targeted the bus carrying the Borussia Dortmund footballers on April the 11th, written notes left at the scene claimed the attack was the work of ISIL. The truth, as is now alleged, is remarkable.
On April 21st, the police arrested a man in a southern German city called Tübingen. He was on his way to work, and his name was Sergei Venergold. He seemed like an unlikely suspect because he had no known connections to the Islamic terror world. He didn't seem like a far-right extremist. He didn't seem like a left-wing extremist either. He seemed to be a completely unremarkable young man.
A 28-year-old German-Russian man, named only as Sergei W., stayed in the same hotel as the players on the night before the bombing. He specifically requested an upper room overlooking the bushes where the explosive devices were hidden.
The media dissected why he would do that, what was his past.
He had been inspired by the 2015 terror attack in Paris. And he noticed that in the aftermath of the attack, the stocks of French companies went down. And he believed that if an attack took place that was directed at a specific company, that the decrease in stock price for that company would be even more dramatic.
It never occurred to anyone that someone would do that out of greed.
We now know that the suspect bought 3 different derivatives on the Borussia Dortmund shares. With all these derivatives, he bet on falling shares. The suspect bought the majority of these financial products on the 11th of April, the day of the attack.
If the plot had been completely successful and the stock had reached a value of 0, Venergold would have made up to 570,000 euros, or the equivalent of about $608,000. Ultimately, the plan completely backfired.
The attacker, Sergei Venergold, didn't make any money. In fact, he lost money.
In court, he would be extremely quiet. He usually kept his hands clasped together. One of the lawyers actually commented that he had never seen a defendant act so calmly. Venergold had served some time in the German military. From that information and from online research, he was able to figure out how to assemble remote detonated bombs that would do what he hoped to do. There were a few days of extremely emotional testimony, including the soccer players who described doubting whether or not they could ever play another game again.
It brought everything back up, and it didn't quite help them to kind of process what was going on.
Throughout it all, he sat there completely silent. The big mystery that was swirling around the trial was the question of why. He may have simply done it because he wanted to impress a woman. Rebecca is a young woman who has a very troubled home life. She ultimately sees her relationship with Venergold as an opportunity to leave that troubled home. Venergold is a Russian immigrant to Germany. He speaks with an accent. He has anxiety in large groups of Germans. She begins to resent the fact that he has these fears and feels a little bit trapped. Rebecca attempts to dump him on multiple occasions, and he threatens to commit suicide if she leaves him. Weinergold apparently told Rebecca that she would soon be seeing a surprise. After being dumped via text message, he apparently began planning for this attack in earnest. Weinergold was charged with 28 counts of attempted murder, which carried a maximum sentence in Germany of life in prison. He claimed that he had nothing to do with the attack, but as time went on, he admitted that he had actually been the person who had built the explosives and had set them off. But he claimed that he didn't want to actually kill anybody. Ultimately, Weinergold didn't receive the harshest possible sentence. He was given 14 years in prison, but it's still a considerable amount in jail in Germany.
The threat of an asteroid hitting Earth is very real. If it's big enough, it's also very final.
These are very, very infrequent events. The probability is not zero, though.
A blinding flash of light streaking across the sky.
About 100 tons of space rock falls on Earth every day. Most of it is so small it burns up in our atmosphere or lands unnoticed away from major populations. No human in the past 1,000 years is known to have been killed by a meteorite, and according to NASA, no large object is likely to strike the Earth any time in the next several hundred years. However, one thing is certain: we haven't found them all.
There are thousands out there, and we don't know where they are.
There are a lot of asteroids in our solar system. They number in the billions.
Scientists all over the world are working toward detecting and deflecting the most catastrophic of natural disasters.
The race is on to find as many of these objects as we can.
We have a way of calculating whether or not an asteroid is potentially dangerous or not.
I mean, I think it's something worth investing in. It's our existence at stake, right?
Amy, let's get this one out of the way. It's probably the question you get asked the most, but how scared should we be?
Asteroids and comets are a natural hazard that's out there like a lot of other natural hazards. These are very, very infrequent events, these collision events, where an object actually impacts the Earth. The most important thing that we need to know about asteroids is when the next impact is going to happen and how bad it will be. What we know is that an object that's about, say, 1 kilometer across is capable of causing very, very wide devastation across the planet, really, truly global devastation. The object that wiped out the dinosaurs was somewhere in the neighborhood of 5 to 10 kilometers across, so even bigger than that. At 1 kilometer, it's still going to be very bad and will have global effects. For objects that are capable of causing what I would call sort of regional damage, kind of a large major metropolitan area, a city and its surrounding environment, sort of around 100-ish meters. It depends on the details of the composition and so forth.
By the 1980s, NASA was cataloguing near-Earth objects. In 1994, stargazers watched as comet Shoemaker-Levy 9 hit Jupiter. The resulting zone of chaos was estimated to be as large as the Earth, and the event became a turning point in the search for asteroids and comets in our solar system. In 1998, Congress tasked NASA with finding 90% of asteroids and comets 1 kilometer wide or larger. Soon after, Hollywood blockbusters Armageddon and Deep Impact brought attention and fear to the masses.
The great news is that the vast majority, more than 90% of all the really large 1 kilometer near-Earth objects have been found. The challenge now is working down to these smaller sizes that are still quite capable of causing a lot of damage, but they're just harder to spot because they're fainter, they're smaller.
Can you give us a sense of how many are out there in our solar system?
We know that there are a lot of asteroids in our solar system. They number in the billions. Most of them, however, are between Mars and Jupiter in what we call the main asteroid belt. This is a region of space where most of the asteroids in the inner part of our solar system live, and they stay there for many billions of years. There is another population, though, that kind of leaks inward and gets into the region somewhat close to the Earth, and we call these near-Earth objects. We think that there are millions and millions of near-Earth objects that are out there in the total population. As of today, we know of sort of around 25,000, something like that. When we first spot an object, we really know very little about it. We just see something moving across the sky. So all you get is just sort of a handful of snapshots, just enough to be able to tell that this isn't an asteroid that we've already seen before. And then once we can calculate the distance to it, we can now start to make predictions about its true size. Is it large or is it small? So we have a lot of information that we have to get pretty quickly to really understand what's going on.
Finding asteroids is just one piece of the puzzle. Planetary scientists are extremely skilled in determining the orbits and speeds of asteroids based on relatively small amounts of data. NASA runs simulations of the trajectories asteroids could take, which is useful but time-consuming. A team of scientists in the Netherlands have found a way that could buy us more time.
Our method is very quick. So you can very quickly get an assessment of whether or not the object is dangerous or not. If you look at the classical way of determining the danger of an asteroid, it may take days of computing time on very big machines to determine this hazardousness.
The current problem is that there's just too many asteroids out there to spend a huge amount of computational power on all of them. So the neural network allows us to focus on what really could go and pose a hazard to Earth.
A neural network is a computing system that mimics the way the human brain operates to find underlying relationships in a set of data.
By training the network in this way, you train it in recognizing those objects that are most likely to hit the planet. And once it's trained, you can apply this network to all the unknown asteroids. And then you can make a selection and saying, hey, these are the ones which appear to be having orbits similar to the ones which we know are hitting the planet. That doesn't mean that they do, but it only means that they look very similar to the ones we know they do.
What else did you find? Should we be particularly concerned about anything?
One thing that we did find is that our neural network was able to go and identify a handful of asteroids which weren't considered potentially hazardous, that when we went and integrated them forward in time, they came quite close to Earth.
We find a handful which were not detected before or not considered being dangerous before, and we think they are potentially dangerous.
It's very hard to simulate kind of going forward in time an asteroid that's going to hit Earth because, well, the Earth is really small. And space is really big, and then you have to have very exact parameters to shoot an asteroid that goes and hits exactly Earth. And then Simon had the ingenious idea of not even trying to do that and just launching the asteroids from Earth's surface and integrating backwards in time.
It's very hard to make it hit. So you need a lot of calculations which all end up in nothing. And the idea was then let's not do that. This is basically what NASA is doing. NASA is taking an asteroid, making multiple copies of them, shooting them all forwards in time, calculating their orbits, and then see what fraction sort of gets close to Earth. Not even hitting Earth, but getting close to Earth. And that they call it a potential impactor. So you calculate the solar system forwards in time for, let's say, 1,000 years. And then you launch asteroids from the surface as if you go forwards in time, would fall on the surface. You calculate them backwards to today, and then you get your orbital parameters of today's asteroids, which you know will land on the planet. And those you can use as known impactors and compare with all the other asteroids in the solar system.
Can simulations and AI, can those things fill in the gaps where perhaps telescopes and other imaging tools can't?
Absolutely. Since the observations get more complex, the physics gets more complex. And if the physics get more complex, the mathematics becomes more complex. And at some point, you can't solve your problems analytically anymore. And then this is where the computer comes in. Now we have this trained neural network. We have a way of calculating in a fraction of a second whether or not an asteroid is potentially dangerous or not, and therefore deserves more attention or more time to spend on for really finding out if it is dangerous.
When it comes to hunting asteroids, time is critical.
What we can do about a potentially hazardous object depends a great deal on what we know about it and how much time we have before the encounter. We'd really like to find them when they're decades away, because the more time you have, the more options you have, and the less energy it takes to move an object aside.
It also means we might not have to resort to launching a nuclear warhead at an asteroid. Until recently, pretty much our only choice.
That's an option of last resort, in my opinion, yes. We have lots of options available. You can just simply bump into the object and just nudge it out of the way. That's one possibility, and that's kind of, in a way, sort of the simplest thing to think about, just nudging it off its path a little bit with, a massive object, a spacecraft, let's say. It's kind of like bowling, if you will. If you have a long time or a long stretch of runway in the lane, just a very small twist on the bowling ball will make a big change in where it ultimately ends up. Another option would be something where you take a very big, massive spacecraft and you park it next to the object and you use the force of gravity as a towing rig. That takes longer, though, and you need to be able to send a pretty massive spacecraft, and it obviously depends a lot on how big the asteroid is. Other options start to get more and more complicated, and they range from painting one side of the object a white color and painting the other side dark, and then letting the pressure of light sort of perturb its orbit.
In a departure from the lab and computer simulations, NASA has real plans to rehearse kinetic impact deflection. In 2021, the agency will launch DART, the Double Asteroid Redirection Test mission, which will intercept a 160-meter asteroid in 2022. Better to practice now before we have to deal with an actual threat. In the meantime, discovering asteroids is our best bet. Thousands of scientists and amateur astronomers around the world make up an informal network that survey the heavens. But that may not be enough. NASA wants more resources to map our solar system and better technology.
We need to ramp up our network of sensors, and also we need to just continue to strengthen our network of international observers so that we can get follow-up, because we find these objects when they're distributed all over the night sky.
Once we get more observations, we get better data, we can make better predictions.
If you look at the big impactors we have had in the last, let's say, 20 years, or maybe 30 years, or 50 years, most of them we haven't seen coming. So the real danger, I think, comes from the objects we don't know about, and not from the objects we do know about.
This particular natural disaster, like a lot of natural disasters and like climate change, is a problem of the global commons. So the thing that we risk collectively is that it sort of then becomes nobody's problem, and nobody takes ownership over it. The asteroids are all over the sky. They just truly cross boundaries and borders with a second's notice.
I kind of imagine in the future, maybe lots of small satellites around the Earth that are always going and looking outward. I mean, I think it's something worth investing in. It's our existence at stake, right?
The pandemic has affected everyone in different ways. Some passed the time by baking.
Homemade sourdough bread. Do I need to say more?
Some chose to binge watch Netflix.
It's your game.
Or maybe you started a garden oasis in your backyard.
Next, I'm going to put my lettuces in.
But for millions of others,
I'm going to be posting stocks that will boom.
They wanted to uproot the financial industry.
Let's just lock it on up and take $15,000.
Here's a stock that can change your life.
I see a stock going up and I buy it, and I just watch it until it stops going up, and then I sell it.
I have gained over $3 million.
I want some free money.
I don't think you can overstate the online communities or social media's influence on financial markets.
A large group of inexperienced investors who discuss their plans on social media platform Reddit have shaken up the stock market in a big way.
The stock that everybody's talking about right now is GameStop.
Video game retailer GameStop is set to continue their head-spinning ascent today.
The revolutionaries on Reddit are spanking Wall Street's ass.
The more these stocks go up, the more the big guys are getting creamed and losing billions of dollars.
This isn't a wealthy person's game anymore. Anyone can play it.
I took up a little bit of a new hobby, and I am interested in day trading.
As an investor nowadays, you don't have to look a specific way. You don't have to wear specific clothes. You don't have to be doing it from a trading floor on Wall Street in like a high-rise building in downtown Manhattan.
The narrative of what's driving the markets is no longer being held in secret offices in New York and Boston of privileged people talking to other privileged people. It's right out in the open. It's on Twitter, it's on Reddit.
From brokerage apps to Discord channels and subreddits to TikTok finfluencers, one of the last holdouts in the world of disruption, finance is next in line.
Investing should be as ubiquitous as shopping online.
That's Vlad Tenev, the CEO of Robinhood, the online brokerage app, talking about how he wants his app to disrupt the world of stock trading like Amazon disrupted the world of home shopping.
And I think that speaks to exactly the mission that a platform like Robinhood has, which is to democratize investing.
Robinhood was started in 2013 by Vlad Tenev and Baiju Bhatt in, where else, Silicon Valley, as an alternative to the big brokerages, but with one big difference.
As they were building the social network around finances for people, they realized that there was a gap in the market and that free trading could become something that they could bring to the markets, they could disrupt the industry.
While no-fee trading is industry standard today, it was unheard of when it was first introduced.
The online brokerage industry was really innovative when they came on the scene 10, 15 years ago, but they kind of stopped innovating where you haven't seen those commissions come down beyond $5 or $6 or $7. Robinhood think that by offering zero commission that they're going to push people onto this platform.
And on top of no-fee trading, the customers Robinhood was courting have been long overlooked in the world of finance.
So the typical customer of a Charles Schwab, for example, is putting a lot more money in that brokerage account than the typical customer at Robinhood. Even today, with all of its popularity, the median account size is about $240.
There's Fidelities and the Schwabs and the E-Trades of the world. They look down their nose at those kind of accounts. I don't want a $1,000 account. They're just a headache. I want a $100,000 account.
And this is key here, right? Because the thing about Robinhood that's different than every other single brokerage platform is how easy it is to use.
The design of the Robinhood app really has in mind a user who might be coming at this absolutely cold.
The fonts are very well sized, the shapes, the colors, all of that is something that the founders of Robinhood paid really close attention to.
And by creating an interface that catered to a newer investor, they were able to gather a pretty healthy group of customers. And by 2019, they had about 10 million customers.
Those 10 million customers were a huge success story for Robinhood, but no one could have predicted its explosion after the arrival of COVID-19.
Remain indoors to the greatest extent
and 100% of the non-essential workforce must stay home.
What we saw when the pandemic hit was the growth of Robinhood users absolutely turbocharged. And oddly, you saw this surge in interest in stock trading. Then they saw the absolute surge in 2020 in customer growth. And now, by many accounts, they have more than 20 million customers, which is pretty extraordinary. So the next step for them is to figure out how to monetize those users and how, even with their small account sizes, to get them to grow with the company and, as it releases more products, come along with them.
Robinhood would become one of the COVID economy's breakout successes. Robinhood traders, as they're called, became the shorthand explanation for the frenzy of often speculative retail investing after the pandemic lockdowns.
Kids wake up in the morning, they go on Robinhood. They're, in the shower, they check Robinhood. Kids are learning how the stock market works at 18 while they're at school, checking their phones in between classes because notifications pop up telling them what their stocks are doing that day.
With these new tools, millennials and Gen Z are investing in the market in ways their parents could have never even dreamt of.
That is sort of key when we talk about the divide between older and younger generations, is that the younger generation is exposed to so much more information and tools at their disposal to do what they want in the market.
The older generations, you never had the technology or the cost structure that you could play the markets like you can today. So you were stuck with giving your money to a professional investor and paying them a fee to do it.
When I speak to young kids, they tell me, I'm making mistakes, I'm losing money. I'm not a perfect investor, but I'm 18, and by the time I'm 30, which will be, 10 years from now, I'm gonna have interacted with the markets for a decade. And so it's a learning experience more so than anything else.
And you can look at it and you can say, wow, that's risk-taking, that's dumb, but if you could possibly shave 10, 20 years off your working life versus adding 5 years, I don't think you can fault people for that.
But Robinhood is only part of the puzzle. Sure, you can trade on it, but without research, information, and data, you're just blindly throwing darts at different stocks and hoping to strike it rich.
Wall Street forever has always run on what we now call narratives or memes. People telling rumors to each other have been around for 100 years.
On Wall Street, information is its own currency. Historically, either you had it or you didn't. And the people who had it had a huge advantage.
In the past, those narratives and memes didn't have a network effect. It would be one person telling another person over the phone. In fact, when I broke into this business in the 80s, a lot of people used to complain that they weren't on the call list to get those ideas.
Social media changed all of that.
Fast forward to 2021, that's being done on the internet now. And that's being done on Discord and Twitter and StockTwits and Reddit. And the impact is very similar, but orders and orders of magnitude larger.
As social media has played a bigger part in our lives, it's also played a bigger and kind of more important role in how people find investing ideas online and on these platforms.
How do those ideas spread? On TikTok. Yes, that TikTok.
Soon may the weatherman come to bring us sugar and tea and rum.
People aren't just going to it for sea shanty videos.
The personal finance hashtag on TikTok has garnered 3.5 billion views from its 1 billion monthly active users. By comparison, videos found under the cooking and health tips hashtag have 2.6 and 2.1 billion views respectively.
The trajectory of Robinhood and TikTok were literally on par.
What happened in the stock market this week? So the word of the week is expectations.
Absolutely essential that you guys understand the risks of shorting.
And Kayla Kilbride and Kyla Scanlon are two of those financial influencer TikTokers, also known as finfluencers.
I think people still care about fashion, they care about culture, but it's also like there's this big behemoth thing called the stock market that we really don't know a whole lot about, and it's gatekept behind the industry. And so people like want to unpack that. And so my audience is, a lot of them are younger investors who are looking to hone their skills.
Tech and write up.
Kyla and Kayla are two of the more, let's say, professional TikTok influencers.
The Tesla ARK Bitcoin Biotech Risk Cluster.
I've been trading since high school, and it was a really interesting way for me to fill out my decision-making frameworks and to think about thinking. And I think that the more that we can have people thinking about finance, the better that we're going to progress as a society. I think it's a huge gap in our educational system.
If you're going to buy an option for a stock you think is going to go up, it's a call. So think of it like this. I made the options video where I was like, options are just like shopping. Rumor has it that this pallet's about to go up in price. So if I come in tomorrow, can I still buy it at said price? And a ton of women just like attacked that video and were like, you explain things so much better than my boyfriend or my professor, or like I could sit and listen to you all day. And I was like, this is what I was looking for.
But TikTok's algorithm does not reward calm and measured videos about responsible investing. It rewards this.
Watch this video for 30 seconds and you'll be rich for the rest of your life.
I try not to say the A word, the ALGO word, because TikTok listens to us.
The algorithm does impact how you feel. You know, you do notice which videos do better versus which videos do worse.
How do you catch someone's attention in less than 60 seconds? And how do you make it something that they're like, I need this in my life? Nearly impossible to do that in 60 seconds. But the people who perfect it are the people that you're going to watch and going to stick around.
And where people are sticking around? Reddit. And its nearly countless subreddits about finance. And by far the biggest one of those is Wall Street Bets.
There's a lot of social media platforms out there, but Reddit is like the social media platform for finance. Places like Wall Street Bets is where it all goes down.
Started in January 2012, it wasn't long before Wall Street Bets adopted a 4chan-like etiquette, leading to their tagline, like 4chan found a Bloomberg terminal.
We had all these unexplained stock moves, and we would be grasping for why stock XYZ jumped 20% in a day. And you would look at Wall Street Bets, and you would see people there talking about buying options in that stock, and it sort of, squared the circle, so to speak, and started making sense. And it was at that point that it was like, wow, we have to start paying attention to this.
Some people on the platform really spend tons of time, and others are just looking for entertainment and to have a little bit of fun, effectively gambling or looking for an outlet, trying to make a little bit of money.
Then on top of all of that, there were stimulus checks. Now clearly this money is going to people who need to use that to eat, to live, but there's a lot of people who use this money to invest in the stock market.
And it's not just stock tips. People quote-unquote YOLO their entire life savings or stimulus checks on a single stock. They post what is called gain and loss porn, screen-grabbing staggering hits and misses on stocks for the entire community to see.
I'm about to lose everything.
And while some of the people on Wall Street Bets are novice investors, the community contains multitudes.
In one respect, what it did show us among these network groups is they are very sophisticated. They're not a bunch of ignorant people talking to other ignorant people.
And this is where the pieces of the puzzle all come together to wreak havoc on Wall Street for a solid week in early 2021.
It's pretty clear that the combination of more people having retail brokerage accounts and trading apps and more people being stuck at home looking for some kind of entertainment and some kind of community online came together in this very singular way.
What came together is GameStop.
Let's go back to the beginnings of what happened with GameStop a couple of years ago. On the boards like Reddit and StockTwits, a lot of people were talking about GameStop as being attractive value.
Some of them are even, Wall Street alums who left the industry and now still have access to tools that they can use to improve their financial well-being and make very good decisions. And I think Roaring Kitty is a perfect example of that.
GameStop is one of the most compelling asymmetric opportunities in the market today. Really, I don't understand how you could disagree with that.
At the same time that this crowd was talking it up, the hedge fund institutional crowd didn't like this stock at all, and it had the largest short interest of any stock in the New York Stock Exchange going into late 2020.
Short selling is a bet that a stock price will fall, and it's a fairly simple concept. An investor borrows a stock and then sells it. The investor is betting on buying the stock back later for a lower price before returning it to the original owner, pocketing the price difference.
What a short seller would tell you is that they almost act as a policeman in financial markets, or they're at least looking for companies that aren't what they say they are. And that can range anywhere from an outright fraud that some short sellers try to expose to just a company that's not worth as much as investors think it is.
The problem is, if the stock price rises, the short seller has to come up with the money to buy the stock back. And the more it rises, the more it costs. And that's what's called a short squeeze. And the hedge fund Melvin Capital was on the wrong end of that squeeze.
Melvin Capital lost over 50% of its money in the month of January alone, just from being caught in the short squeeze of the stock.
This is where the disruption comes in.
One of the most wild stories you're ever going to see. GameStop shares absolutely going nuts.
In less than a year, the company's stock has jumped from less than $3 a share to almost $350.
Cheers, everybody!
Roaring Kitty has turned $50,000 or so investment into some $14 million.
Whoa!
Investors all over social media use the free trading app Robinhood to wreak havoc on Wall Street.
They're actually piling on into some of these stocks to really hurt the professional short sellers.
And they all used Reddit, Twitter, TikTok, and Discord to tell one another to keep buying and, quote, hold the line and not sell GameStop.
People are getting cheerleaded for jumping in, buying at the highs. They're saying, keep going.
And it was working too, until
Thursday morning, the trading app Robinhood sent out this tweet. In light of current market volatility, we are restricting transactions, including GameStop.
People were really angry.
Robinhood was supposed to allow the regular people to play the same game these big boys are playing. But instead, we were all taken for schmucks, and they screwed us.
Shares of GameStop are jumping again now that retail investors are being allowed to buy shares of the stock.
But what we learned is that when people organize online, they have the ability to disrupt the market.
And it was a big sign. The ivory walls of the institution aren't as powerful as maybe the institutions thought them to be. I don't know if pumping up GameStop was the best use of billions of dollars, but I think that as a signal to society, it was pretty interesting and powerful.
The GameStop saga was so impactful that both Vlad Tenev and Roaring Kitty were called in to testify before Congress to clarify each of their roles in the saga.
One thing that's emerged from the congressional hearings is that they're interested in how retail brokerages make money and whether they're keeping the best interests of their customers in mind. But it's pretty fuzzy as far as what they would actually do as a result.
While the frenzy around GameStop eventually subsided, it didn't take long for retail investors to find other areas to invest their money.
Take a look at Bitcoin going bananas over the weekend.
Bitcoin forms a brand new all-time high.
It was after GameStop started to drop that we saw Bitcoin really go up to over 60,000.
How much further does this rally have to run?
It's compelling to say that money shifted from one venue to the other.
While correlation doesn't equal causation, there's a chart out there showing an inverse correlation on meme stocks going down and cryptocurrencies going up.
There's definitely an aspect where people are making money on stocks and then moving, they're agnostic, they're not hedge funds. They can invest wherever the hell they want. It's a classic sort of momentum trade. They're going to wherever the winners are and they're willing to jump on and, ride it.
So whether it's meme stocks like GameStop, meme coins like Dogecoin, or entirely new ways to invest in art like NFTs, the new kind of retail investor is making its presence known.
Over the next 10, maybe 15 years, you're going to continue to see, whether by choice or by force, that baton go from older generations to younger generations. I don't think any single app is going to be the thing that disrupts. I think people are the disruptors.
How people get ideas about what to invest in has become increasingly entwined with social media. And as social media companies govern more and more of our lives, the fact that now they're tied